Merci beaucoup. Comme je l'avais indiqué.
As indicated this morning, we had an ECOFIN meeting almost exclusively dedicated to Ukraine and the economic consequences of the war in Ukraine. We reiterated our financial support to Ukraine and I'll come back to this, examined new sanctions to be taken against Russia. Before that, we had a very interesting discussion with the Ukrainian finance minister, Serhii Marchenko, who gave us his thoughts and expectations for the EU's support and our sanctions. I think it was a key moment for European finance and economics ministers. And we were struck by the determination and composure of the minister. We then had a minute of silence in honour of the victims of the war in the Ukraine, following a request from Minister Marchenko. On the sanctions, we reiterated the determination of all 27 member states to pursue the sanctions already adopted and step up sanction efforts. And this was a unified effort and commitment by the 27. Facing Russian aggression, we have to be more unified than ever. And all member states reiterated their willingness to expand import restrictions and step up efforts against Russia. And we discussed extending the list of individuals under sanction and companies as well. Member states also stated their willingness to include the energy sector under sanctions following a timeline yet to be determined. And the President of the Republic had already on Monday morning stated very clearly France's desire to have coal and oil considered for sanctions against Russia. And therefore the discussions amongst member states followed that line, and we look forward to Commission proposals. We also discussed the general economic situation in the European Union and the response to the consequences of the war in Ukraine. Our shared challenge is facing inflation. That is the challenge we're facing now and for the months to come. And for years now, we have had a weak, low level of inflation in Europe. But inflation is back because of energy prices. Those energy prices are being pushed up and general prices are following. Once we have a more stable situation, we expect that we will see a more normal level of inflation, however, one that will remain higher than it was before the crisis, partly for structural reasons, also because of decisions to relocate production. Of course, producing in Europe makes us more independent, but it will cost more. And another factor pushing up prices, of course, necessary investments to deal with climate change. And we hope that we will have a more reasonable level of inflation when we come out of this crisis, but which will, of course, be higher than the pre-crisis levels. In the short term, we wish to protect our citizens, protect them from the hike in prices, which for many of them will be unaffordable. For example, when it comes to fuel prices, certain member states have taken measures to protect citizens. For example, in Spain and France, there have been special discounts for such fuel prices, and similar measures have been taken by other member states. And we agreed on the need to coordinate our response, particularly when it comes to how we deal with business, with companies. And we want our policies to be focused on those companies that are likely to be hardest hit by energy price hikes. And then we also discussed the need for a long-term response, because this is going to be part of a new economic cycle. Our long-term response can be summed up in the need for independence. We want European economic independence. We want to reshape our production changes and our production and respond to climate change. We also discussed a global minimum level of taxation for multinational groups. And together with the President of the Republic, we have worked based on his initiative to set up this global minimum level, both at European and global level. We've been doing that for 5 years. It has been a fight being pushed for by France, supported by a number of member states, and supported by all EU member states, without exception, because all EU member states gave their approval to the OECD proposal for a global minimum level of 15%. The European Union, together with the Commission, has now translated the OECD agreement into a directive, and we thank Valdis and the Commission services for the work done there. We examined this text 3 weeks ago, and certain member states, as I said, did raise technical issues, legitimate technical concerns, which we addressed, each and every one. And there were therefore no more technical obstacles to the adoption of this directive, because we had addressed those issues. We also addressed the issue raised by Poland about the link between digital taxation in Pillar 1 and minimum taxation in Pillar 2. And we came up with a joint statement making it clear that we intended for Pillar 1 and Pillar 2 to be implemented as swiftly as possible. Poland decided to oppose this text, this directive, which means that it will be back on the agenda for upcoming ECOFIN Council meetings. But as I said, all technical obstacles have been lifted in the way of this directive, but we will continue to pursue this goal, which we believe will be a step forward until it is adopted.